course, today's lecture, which is about accounting and a continuation of what you had before from a legend of accounting professoriate, C.J. Skender, is these are great skills and also great ways to produce questions for exams. So I hope you get a lot out of today's lecture, and I encourage you to pay attention and welcome one of our great colleagues at Carolina, C.J. Skender.
Just so you know, Alice Cooper is not the same as Al Cooper. Hoping that everybody picked up. Alice Cooper was the mascara rock guy that was in, what movie was Alice Cooper in? Wayne's World. Party on, class. Way to go. So I'll start out with a Motown song since Dr. Thorpe mentioned Motown. Baby, baby, I'm aware of where you go. Each time you leave my dough, I watch you walk down the street, knowing another love you'll meet. This time before you leave my arms and rush off to her charms. Think it over. Haven't I been good to you? Think it over. What? Before you break my heart. Yes, you know who sang it?
The Supremes.
Diana Ross and the Supremes. Supremes.
Ask me
Who played the bass? You know who played the bass?
Same answer, guys. Same answer for every Motown song.
Now you know.
James James.
Played the bass. Standing in the Shadows of Love was a song by the Four Tops. Okay, and they had a terrific guy who had a deep, low voice like James Worthy. Okay. His name was Levi Stubbs. FYI. Here's the movie. What's wrong, Mommy? First Class is what's wrong. Used to be a better meal. Now it's a better life. I could not have stumped you. Okay, same movie. You complete me. Shut up. You had me at hello. You had me at hello. Say it.
Jerry Maguire.
Yeah, Jerry Maguire. Good. Okay, does anybody know it? Anybody remember her name in that movie? Renee Zellweger? Dorothy Boyd. You can look it up. All right, on to accounting. If that didn't excite you, you don't have a pulse. All right, this is what we did last time. I'm going to hit those things very quickly. You have these in your notes from before. The fellow who started it, Luca Pacioli, wrote about it, but it existed a long time before then. The FASB, Financial Accounting Standards Board, makes the rules, but the congressional power rests with the SEC, Securities and Exchange Commission. All right, we talked about some definitions. Assets, very simply, economic resources. If you got a chance to look at the financial statements of Starbucks or the financial statements of Walmart, you saw lots of examples of assets, lots of examples of liabilities, lots of examples of owner's equity. From those, we put together a balance sheet equation. We said that assets were equal to liabilities and owner's equity. All right, magic formula. All right. We looked at revenues and expenses and defined them. Revenues, an increase, inflow of net assets from providing goods or services. Expenses, outflow or decrease. Define the net assets as total assets minus total liabilities. Another way of saying that is owner's equity. All right. Talked a little bit about taxes, how they make the good times not as good, and then the bad times not as bad. All right. Our equations with respect to the income statement, net income were revenues minus expenses. The balance sheet, assets or liabilities are equal to liabilities plus owner's equity. If you have any two of those three numbers, you can figure out the third one. All right, we did a couple of pages to reinforce your understanding of how revenues occur. Either assets increase or liabilities decrease. How expenses occur, either assets decrease or liabilities increase. And then just to give you some terminology, the real accounts, the permanent accounts, are the assets, liabilities, and owner's equity. Given that name because whatever their ending balance is one year, that becomes the beginning balance the next year. Revenues and expenses are nominal or temporary. They'll be closed out. We'll make them zero at the end of each year so that then we can start the new year fresh. All right, did some numerical questions on the next 2 pages. And in fact, the questions that you did on the quiz, all right, were comparable to those. I'm going to go to those just to rehash those. Most folks got them right, like 90%. And if I can find them up here. All right, the first one says at the beginning of the year, assets are 120, stockholders' equity is 80. If we use our balance sheet equation, A equals L plus OE, assets or liabilities plus owner's equity, at the beginning of the year, the assets were 120, the stockholders' equity, this is a corporation, is 80. They don't ask this, but we need to know the liabilities at the beginning of the year, 40. I was on that road this morning. Assets increased by 50. That takes us up to 170. Liabilities decreased by 18. That takes us down to Desmond Tutu. And so what we're looking for is the owner's equity at the end. 22 plus what is 170. Final answer, 148. And I think something like 90% of the people got that right. So that's outstanding, bordering on spectacular. All right. And then the one at the bottom is asking us to look at changes that occur from the beginning of the year to the end of the year. So I'm going to put A for assets, L for liabilities, and then I'm going to break the owner's equity into 2 pieces. CC for contributed capital, RE for retained earnings. When the company was started, the assets were 90. The liabilities were 27. When a company starts, its retained earnings is 0 because retained earnings, by definition, represents accumulated net income in excess of dividends. All right. So you have no net income when the business starts. So that was the first thing that we solved for. We can then get the contributed capital saying what plus 27 is 90. That's got to be 63. So we have our balance sheet as of the beginning of the year. All right, when we get to the end of the year, this is what we are told, that assets were 140 and liabilities were 40. Additional investments by the owners were 9, so that 63 is increased by 9. Now it's sitting at 72. All right, so we did solve for the 72, and now we're going to solve for the retained earnings. The total assets of 140 have to equal the liabilities and owner's equity, so they have to be 140. Right now they're 112. 112 plus what is 140? Your retained earnings has to be 28. Now, from there, we're going to do a statement of retained earnings where we take the beginning retained earnings, add to it our net income, which is what we're solving for. That's the big question. To give us an available number, if I subtract from that the dividends, what I'm left with is my ending retained earnings. All right, well, in this situation, I know my beginning and my ending. I had to solve or know both of those. 0 at the beginning, 28 there at the end. I'm told the dividends declared and paid were 22. Say to yourself, 22 from what is 28? 50. 0 plus what is 50? Answer 50, and that was C. All right. Both of those are sort of building around the balance sheet and building around relationships in terms of the changing. Every account can change. Take a beginning balance, add something to it, subtract something from it, and that gets us the ending balance. All right. What I asked you to look at for today was a chapter of a textbook that a fellow up at the University of Richmond and I wrote, creatively entitled Financial Accounting. The purpose of asking you to skim over that chapter is so that you could see how debits and credits work, how the model of accounting works in such a way to create financial statements. And if you read through the chapter, in my biased opinion, I think it's well written. The chapter starts out just describing transactions. If you go to page 86, there's a list of 10 transactions there in the gray that we will look at or go through. At the beginning of the chapter, they say, well, if we purchased inventory on credit for $2,000, the asset inventory goes up $2,000, the liability accounts payable goes up $2,000, and we're still balanced. If you look at number 2, we pay the regular salary of $300 to an employee for work done during the past week. Well, what happens there is our asset cash goes down. At the same time, the owner's equity is going to go down. So if we're just looking at it from a balance sheet standpoint, the balance sheet always has to balance. But in this case, that salary that's being paid is an expense. And so the beginning of the chapter gives you the way those things move. What I'd like to go through with you is the model, and then we'll take each one of those entries and show you the journal entry and then where it goes to put together an income statement and a balance sheet at the end of the year. So here's the model, and I introduced this to you last week, but just sort of left you hanging. We have an account that is called a T account. It gets that name because it's in the shape.
I think we might be able to lift this for you.
Oh, I like bending over. That's my exercise.
Are you sure? Is that okay?
I'm trying to get dashboard abs, washboard abs, sorry. You knew what I meant. Dashboard, washboard. So this is called a T account, and on the left side are debit. So if I say debit, you say left. Let's try it. Debit. Great. If I say credit, you say right. Credit. Debit. Credit. You could be a CPA. Where the plot thickens is that I'm going to put our 5 categories of accounts, A, L, O, E, and then down below the revenues and the expenses. Sometimes a debit means an increase, sometimes it means a decrease. All right? The assets and expenses are referred to as accounts with normal debit balances. They will increase with debits. Well, my argument is always if you can get the first one right, if you can do plus and minus with respect to assets, you should be able to get all the rest correct as well. And then it's just a matter of drilling on those things to put them all together. If I want to increase an asset, I record it on the debit side. If I want to decrease an asset, record it on the credit side. Now, since the liabilities and the owner's equity are on the opposite side of the balance sheet, how might you suspect that the liabilities and owner's equity behave compared to the assets? In 2 words, the opposite. Good answer. Like the way you think. I'll be watching you. So if I want to increase a liability, that's a credit. If I want to increase owner's equity, that's a credit. And then if you think back to our definitions that revenues represent an inflow or an increase in net assets being owner's equity, they'll behave the same way. The expenses will be the opposite of revenues. So that little chart, we introduce it halfway through chapter 4, is the way that the recording takes place with respect to accounting. You know, if you're talking to an accountant and they start debiting and crediting you to death, debit means left and credit means right. It's just sometimes that means an increase, sometimes it means a decrease, and that's a function of the type of account we're dealing with. So I should be able to call you at 3 o'clock some morning. I won't. But if I did, I could say debit, asset, and you would answer the phone in a complete sleepy state and say left, increase. And then if I said credit, liability, you would say right, increase. And if I said credit, revenue, you would say right, increase. All right? All built around this model. So as you look toward the end of the chapter, it's actually done for you in terms of those rules. All right, with respect to item number 1, we're going to create what is called a journal entry. A journal entry has an account that is debited, and then next to it, an amount that's debited, an account that is credited, and then next to it, an amount that's credited. Notice that I indented that a little bit, but that's the generic journal entry, and that's the way that transactions are originally recorded. So in the case of our item number 1, where we're buying inventory on credit, the asset inventory is debited. I'm going to put a little A in parentheses there, not to reference the scarlet letter, but rather to remind us that that is an asset. Debit for 2,000, and then credit accounts payable, a liability for 2,000. There's our first journal entry. For the second one, the $300 of salary that was paid to an employee will be a debit to salary expense, which is an expense account, and a credit to cash. 300, 300. All right. With respect to number 3, we borrowed $9,000 in cash from a bank and signed a loan agreement. Got cash. All right, I'm going to debit cash. Cash is an asset. If I debit it, it goes up. I do that for $9,000. And I'm going to credit notes payable. Distinct from accounts payable. With accounts payable, you just sort of promise that you're going to pay for it. With the notes payable, you actually sign, and then there's interest that's attached to the notes payable as well. Item 4 says we made a sale of inventory to a customer for $5,000 on credit. Now I'm going to have a 4A and a 4B here. The sale on credit means I didn't get the cash. I will debit accounts receivable, which is an asset, for $5,000, and I will credit a revenue account that I'll label sales, also for $5,000. That recognizes the revenue. All right, that's the entry that recognizes the revenue. In 4B, I'd like to recognize the expense. And so in this situation, I'm going to debit cost of goods sold, which is an expense account, and I'll credit the inventory, and that's the $2,000 that we bought there up in entry number 1. And all of these are in the back of the chapter, so if you want to write them down, that's fine, but they're all back there for you to reference if you want to. Just important for the first time through to have somebody hold your hand and actually say, hey, this all fits into those 5 T accounts, and that's really all we're doing. All right. So they sold something for $5,000 that they bought for $2,000. Their gross profit in this case is the difference of $3,000. Okay, but they're also going to have other expenses offset against that, such as the salary expense up in entry 2. Are you with me? Because if you're not with me, you're against me. All right, then number 5 says we paid $700 for insurance coverage for the past few months. It says this amount has previously been recognized in the company accounting system as it incurred. All right, in this case, we must have an insurance payable on the books simply because of the way that it was described there. This amount has previously been recognized in the company's accounting system. So if we had an insurance payable, that now is going to be debited, decreased for $700, and we're paying it with cash. the asset cash is also decreased by 700. Item 6 says we buy a new automobile for the company for $40,000. We paid $10,000 down and then signed a note for the remainder. This is going to give us a look at what is called a compound entry. There's going to be more than one debit, or in this case, more than one credit. The automobile dong. Where's my automobile? Automobile? That's from a movie, folks. Anybody know? The donger need food.
16 candles?
Yes, I knew a guy would get that. Do you heart Jake Ryan? 16 candles. Yes, here you get candy for that. Who was it? Way to go. Impressive. Ooh. Yeah, that's a little better than Michael Vick, huh? How do you think Andy Reid's feeling today? Number 7 says we issue, so for number 6, it's a compound entry because there's more than one credit in this case. The automobile costs $40,000. That's how we record the asset. Another asset goes down, cash, for $10,000, and then there's a notes payable for $30,000. Recording the journal entries. Okay. In number 7, it says we issue ownership shares to new stockholders for cash of $19,000. The asset cash goes up by $19,000. That's a debit. An owner's equity account called common stock also goes up by $19,000. Assets go up, owner's equity goes up. We still balance. The flowers are still standing. Number 8 says we collect cash from the customer from the sale earlier up in transaction 4. We sold it for $5,000, so now that $5,000 of cash comes in. I will debit cash and I will credit the accounts receivable for $5,000. All right. Number 9. We pay cash for the inventory acquired in number 1. Yes, here. That was the Beatles' White Album. There's all these subtle references that occur during the class. Okay, number 9. So next time you listen to the White Album, these black discs, okay, were called albums. You would put them on a record player and they would play music back when your parents and grandparents were kids. So for number 9, we paid cash for the inventory. That's going to be a debit to accounts payable. The accounts payable goes down, debit, $2,000. The asset cash goes down, $2,000. We're debiting and crediting. Finally, number 10 says we pay $4,000 to rent a building for the next 4 months. Okay? That's going to be a debit to an asset account that we're going to call prepaid rent. All right. $1,000 a month, 4 months, $4,000, and we will credit the asset cash for $4,000. If you kind of followed those 10, or actually 11 because of the 4A and the 4B, if you kind of followed those, you could actually create a balance sheet and an income statement for this company. All right. Now, I'm not going to do that, but I'm going to describe to you how this all factors into creating balance sheets and income statements. And then you have the text that you can look at to see how it all fits together. Well, the entries are shown over on page 109. Okay, I don't know that you can see it in the, God bless you, twice, go for third. Triples are exciting. All right. So that's the entry for those 10. And then what they do after that is they show you how it gets posted. All right, so for example, just look at the cash account. That's in a lighter gray. You can kind of see that. The entry that they make is going to be debited and credited, and then ultimately you're going to get a balance, and then from that balance you'll create an income statement and then a balance sheet. But this is the genesis. This is how it starts. These particular entries then are posted to T accounts or to a general ledger, okay, to a computer, and then from there we create the financial statements from that. But it all is built around debit, credit, left, right, increase, decrease. Debit's always left, credit's always right. Assets and expenses are normal debit accounts. Liabilities, owner's equity, revenues are normal credit accounts. All right. You should be able to recognize an account and put it into one of those 5 categories. If I say accounts receivable, you would say, what kind of an account is that? Is it an asset? Here are your choices. Asset, liability, owner's equity, revenue, or expense. Accounts receivable is an asset. All right. Insurance payable is a liability. Common stock, owner's equity. Sales is a revenue, cost of sales, salary expense, those are expenses. So just to understand or have a working knowledge of what those things are, debits are always left and credits are always right. Whether they're increases or decreases is a function of the normal account balance. Assets and expenses are normal debit balances. They'll increase on the left. Liabilities, owner's equity, revenue, increase on the right. Okay. And again, if you want to see it created in all of the detail, the chapter that I sent provides you with all of that. All right, it's a mechanical process, but you can follow it, I think, pretty well just based on those examples there. Any questions about that? Okay, then the second part of the material that I want to go through with you today is more of a managerial accounting approach. As entrepreneurs, you're going to have to make decisions along the way. And so one of the things that you have to have a working knowledge of is cost behavior patterns. And there's a distinction that's made between variable costs and fixed costs, and then a combination of costs that have both variable and fixed components in there. All right? For variable costs, and you have this handout, this was sent to you, variable costs change in total with changes in activity level. You know, the word level is a palindrome. Frontwards, backwards, it's the same. If I were to draw graphs of total variable costs, all right, whatever the variable cost per unit is would be my slope, and it would look something like that. This is my one crack at being an economist. Draw a couple graphs, and dollars on one axis, quantities on the other. But what we do in accounting is for the unit variable cost, UVC, is we make an assumption that it's constant. Now, we know in real life that's not the case. Okay, if I wanted to buy one Lady Gaga CD, that's $18.99. But if I wanted 400 to give everybody in the class, I'm going to probably get a price break. In our model, that's not taken into account. Our model just assumes the variable cost is constant for each item. All right, those are called variable costs. Then we have fixed costs, and what we'll say about those is that they do not change in total with changes in activity level and I'm going to add a phrase, within a relevant range. All right. We have a capacity. If we were to go above that capacity, we'd have to build another building or rent more space, and then our fixed costs would change. But the assumption that we make there, if I'm graphing total fixed costs, is that they are constant, horizontal. So both the unit variable and the total fixed behave horizontally. If I were to show you unit fixed costs, dollars again, quantity, the curve would approach the x-axis asymptotically. All right, closer, 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 never touches. All right, and think of your cell phone. If you want an example of a mixed cost, you pay $39.99 a month. Well, that's fixed. You're going to pay that regardless. If you go over the minutes, you're going to pay 40 cents a minute. That's variable. All right. As an example of the unit fixed costs, suppose we had a concert last day of class and we invited Nellie to perform. Welcome to Nellieville. Good gracious. And Nellie charged $20,000. Well, if I'm the only one that shows up, I'm way up here on the graph. But if we can get 20,000 people into Kenan Stadium, it's $1 a person. If we get 40,000 people there, it's 50 cents. We could bring him too. Party like it's your birthday. All right? So just understanding that variable costs change in total as activity changes, fixed costs do not change in total as activity changes is a nice starting point. All right, now, many of you have had statistics and have had regression, right? How many people know what regression is or have heard of it? Only a handful. What we're going to look at today is the poor man or poor woman or poor person's regression. All right, it's the equation of a line. You did this in grade school. It's referred to as the HighLow Method. All right. If you saw Sidney Lowe walking across campus, you'd say, "Hi, Lowe." Okay. He was a coach at State. No matter. Y in this case is going to be the dependent variable. I'll write it up here. Y depends, hang in there, on A and B and X. All right, A is going to be my y-intercept. B is going to be my slope. And X is going to be my independent variable. Well, that's the mathematical or statistical approach. What we're going to do from an accounting perspective is say that our Y represents the total costs, and that A represents the fixed cost, and then B is going to be the variable cost per unit, or per something, we'll say unit, and that X is your number of units. So your total costs are going to be equal to your fixed costs plus your variable costs. Variable costs, fixed costs, we have the total. So we want to find the equation of a line, and in this first example, we look for the high observation in 6 months and then the low observation for 6 months. The high is May, 12,000 rooms, $1,160,000. Think of this as a hotel or a hospital. And then January is low. All right, well, if I take the cost, the difference in costs, and I'll put May up top because that's high, and then rooms next to it, my costs for May are $1,160. That was for 12,000 rooms. My cost for January, $680,000, and that was for 6,000 rooms. I've got a difference of $480,000 that I'm going to divide by my difference of 6,000 rooms. My variable cost per room is $80. All right, you with me? If I plug back into my formula, the y hat is equal to a plus bx, I can figure out what my fixed costs are. And since 2 points determine a line, I'll use either the high or the low. If I use high, I've got 1160 is equal to a plus 80 times 12,000. All right, well, my variable costs would be 960,000, and so the A, the fixed cost, is 200,000. If I'm going to estimate, bless you, my costs, I'm going to say the total costs are going to be 200,000 plus 80 times the number of rooms. And so I got my first question, the variable cost per room, 80. I got my second question, the fixed cost per month, 200. If I think I'm going to do 10,500 rooms in July, all I'm going to do is plug the 10,500 into X. I'm going to come up with variable costs of 840. I'm going to add to that 200,000, and my estimate would be 1,040,000. That's the high-low method. So in the event that you get costs and you have two observations, you can do this high-low. It's not as accurate as regression, but sometimes you only have a couple of observations, and so in that sense you can kind of justify it. The problem at the bottom of the page is essentially the same thing with some different numbers. Let me do that one for you, and then we'll jump into break even. May is high again. January is low again. My costs now for May are 860, and that was for 12,000 rooms. January was 680, still, Lionel Richie, and 6,000 rooms. Difference of $180,000, difference of 6,000 rooms. If we divide one by the other, we're going to come up with $30 per room. All right, this is a little cheaper hotel. All right, that's the variable cost. Okay, they'll still charge you $129 or $159 or whatever. But thank you. I knew I would reach somebody with that. If I want to figure out, and I'm going to go high again, y is equal to a plus bx. If I use the 860, that's going to be equal to a plus now 30 times the number of units, rooms. I've got variable costs of 360. A in this case would have to be 500,000. And so the bottom question says, all right, what if in July we think we're going to do 10,500 rooms? Well, my formula, y hat, is equal to 500,000 plus 30 now times x, the number of rooms. And I'm simply putting in 10.5 in place of x. All right, that's going to give me 315,000 of variable costs. My total costs, 815. Guys, we're there. Are you with me? Could you do a high-low problem at some point in the future? I love talking to myself. You meet a better class of people. Could have stayed home with my wife today. and talk to myself. So here I have a little picture. Every picture tells a story, don't it? Oh, God bless you. All right. On the left side here, we have the economist's break-even graph. This is the way the world really works. All right, we do a total revenue curve, and then we do a total cost curve, and we use differential calculus to find out where the place is to profit maximize. If you've had an economics course, you've seen that. You've been exposed to that. Accountants assume the world is linear, okay? It's not, but we assume that for purposes of this. And so we draw our fixed costs. And then we draw our variable costs on top of the fixed costs. So that gives us a total cost line. And then we have a revenue line. And this point of intersection represents the break-even point. All right, the break-even point is where we make nothing. We just break even. Anything to the right of that is profit. Anything to the left of that point of intersection would be a loss. In accounting, there's something called a direct or variable or contribution margin statement that calculates sales and says that's going to be SP, the selling price per unit, times X, the number of units. What are your sales? Selling price per unit times how many I sold. And then using our assumption that variable costs are constant, we say that variable costs are equal to VC times X. That the contribution margin is going to be CM times X. But the total fixed costs are not a function of X. They're constant. They're fixed. They're going to be what they are as long as we are within a relevant range. That'll give us our profit. I'll use the Greek letter pi for that. All right, well, all we're going to do, and I show you that just as an FYI, but all we're going to do is we're going to solve for X here. All right, so I'm going to turn this vertical presentation into a horizontal one. SP times X minus VC times X minus TFC is equal to profit. I want to make the profit 0 because I'm breaking even. And if I collect my terms, I get the contribution margin times X is equal to my total fixed costs. If I want to solve for X, and this is my break-even formula in units, X is equal to total fixed costs divided by the contribution margin per unit. Magic formula. Well, nobody wants to just break even. You want to make profit. Big bucks. No whammies. Well, all I'll do if I want to determine how many I need to sell to make a certain profit level, I'll add the profit in the numerator to the total fixed costs. All right. My selling price minus my variable costs gives me something called a contribution. We can also express things in terms of the selling price. Like we can have the contribution margin ratio that's equal to the contribution margin divided by the selling price. Contribution margin per unit divided by the selling price per unit. Or the contribution margin in total divided by total sales. CMR. VCR, variable cost ratio, is VC divided by the selling price. Here's a question for you. If I add the contribution margin ratio and the variable cost ratio together, what am I going to get? And I'll give you a hint. It's the loneliest number you'll ever do. John in Spanish. What? One. Yeah. So if the contribution margin is 30%, the variable cost ratio is 70%. If the contribution margin is 5%, the variable cost ratio is 95%. I present those because if we want to do this and solve for dollars, SP times X, I've got a formula that has the total fixed costs, and I'll throw the profit there, divided by the contribution margin ratio. So those are our two magic formulas, and I've got a little problem that we can work together that hopefully can give you some practice. If you're going to start a business and you can sell each item, whatever it is, for $5, and it cost you $2. SP selling price $5, VC $2, and you have total fixed costs of $3,000, and you might be able to do this in your head. All right. What is your contribution margin per unit? Well, $5 selling price, $2 variable cost, I've got a contribution margin per unit of 3. What's my contribution margin ratio? It's going to be 3 over 5, 3/5, something I could use right now, 0.6. All right, 60%, just different ways of expressing it. If you think about the formula that we have here, look, in the numerator we got dollars, in the denominator we got dollars per unit. The dollars are going to cancel. We're going to get 1 over units. We're going to get an answer in units. X is in units. If we take dollars and divide that by a percentage, fraction, decimal, we're going to get an answer in dollars. So it all fits. All right, so we figured out the contribution margin. 5 minus 2 is 3. And we figured out the contribution margin ratio is 3/5, 0.6, 60%, all of these. Now the question asks, what number of units must be sold to break even? All right, you want to break even. You have fixed costs of $3,000. People, all I'm going to do is pop the 3,000 up here in my numerator. I'm going to divide it by the contribution margin per unit, 3 per unit, and what I'm going to come up with is an answer of 1,000 units. That's how many units must be sold to break even. So if you don't think you can sell at least 1,000 units, you probably shouldn't be in this business. You can do the fourth question simply by taking your answer to the third question and multiplying it times 5, because the selling price is $5. So $5,000 is the answer. Actually, Allen Iverson's the answer. I mean, we talk about practice, not a game, not a game. We talk about practice. And so I'm going to divide that by 0.6, and looky here. I get my $5,000 as the sales necessary to break even. That's my fifth and sixth question. Okay, in breaking even, my profit's 0. So just in questions 3 and 4, I'm breaking even. You're a step ahead of me. In 5 and 6, I'm going to add Leron profit. Okay, he played for Maryland back in the day. All right. Check out number 5. What number of units must be sold to achieve the desired profit? All right, now I'm going to take 3,000 plus 900, there's my profit, divided by 3 per unit, and I've got 1,300 units. And if I want to do the dollar sales again, I could just take 1,300 times 5. If you wanted to do it with the formula, 3,000 plus 900, all divided by 0.6, and that gives us 6,500. And that's your basic break even. If you're thinking about starting a business, that's something that should be bandied about at some point to see if it's really a go or a no-go. If it's on this side of your graph, yeah, let's do it. But if you can't do 1,000 units, if you can only get 400 or 500, you might want to rethink things. Okay? That's the numerical question. Does that make sense to everybody? You can plug in a couple of numbers. Selling price minus variable cost is contribution margin per unit. If I want an answer in units, I'm going to take the fixed costs and divide it by the contribution margin per unit. If I want to achieve a certain profit level, I'm just going to add that to the fixed costs. If I want an answer in dollars, instead of dividing by the contribution margin per unit, I'm going to divide by the contribution margin ratio. I've got one last question, and then we'll get to the couple of multiple choice. The question's just asking for directions, all right? Determine the effect on the break-even point if total fixed costs increase. You look at your formula, and if fixed costs go up, your break-even point's going to go up. It's in the numerator. If fixed costs go down, the break-even point goes down. Now, if you do your formula, total fixed costs divided by the contribution margin per unit, this contribution margin per unit represents the selling price per unit less the variable cost per unit. So if the selling price goes up, CM per unit goes up. If nothing else changes, my break-even point goes down. Part D, if the selling price goes down, contribution margin goes down, denominator goes down, X goes up. Where do these stairs go? They go up. All right. Part E, the variable cost per unit goes up. Look, if my variable cost per unit goes up, contribution margin per unit is going to go down, and the break-even point goes up. Variable cost per unit goes down, contribution margin goes up, break-even point goes down. All right, just basic relationships. Now we separate the sheeps from the aardvarks. Okay. You want to be an aardvark dictionary. See page 1. It says total. Now we've got a combination. Okay, we've got multiple effects. If total fixed costs increase and the selling price per unit decreases, well, total fixed cost increase had us going up. Selling price per unit decreases, has us going up. We're going up again. All right. Both of those changes would cause the break-even point to go up. But take a look at H. If my total fixed costs go down, well, that causes my numerator to go down. Variable cost per unit increases is going to cause my contribution margin to decrease. Okay. This total fixed cost decreasing caused me to go down. Variable cost per unit increasing is going to cause the break-even point to go up. You can't tell. All right, you'd need more information. If you had unit costs, variable, and selling prices and all that, you could. But just from the direction here, you can't determine whether it's an increase or a decrease. And the same thing with the next one. Fixed costs going up would cause the break-even point to go up. Selling price per unit going up would cause the break-even point to go down. Can't tell. Question mark. The Riddler on Batman, wearing that question mark. Riddle me this. If total fixed costs decrease and variable cost per unit decreases, both of those are causing things to go down. Covered a whole lot of material today. We went through journal entries using the debit, credit, left, right, increase, decrease rules. I'd hope you know the rules in terms of which accounts cause increases and which accounts cause decreases. I think if you want to do more than that, work through the exercises that are in Chapter 4 there. With respect to the cost behavior, you've got variable costs and you've got fixed costs. We carried that forward and did a break-even example to hopefully give you some insight there. Any questions on that?
I have a question.
Yes.
So after 30 some odd years of being an entrepreneur, I understand P&Ls and cash flows, and I know why they matter, and I can do what you just did in my sleep. Why does a balance sheet really matter?
Shows you what you have at a particular point in time. One day. A balance sheet matters because this is what you have. This is what your company has in terms of assets, liabilities, and owner's equity at that point. But it's the book value of those things. All right? The company is worth probably a lot different than the owner's equity total is. But that's just a way to measure it, and that's a starting point. Other questions?
All right, let's give a round of applause to CJ Skender.
Yeah,